Hey everybody, Mike DeSepoli, Heritage Financial Advisory. Welcome to Heritage Insider Weekly for Saturday, April 4th, 2026. Hope you're all having a great week. We are back to update you on the markets and the economy. Our office was closed yesterday with the markets for Good Friday, so we are here on a Saturday to update you on all things that have occurred this week in the financial markets. We finally broke the losing streak that the markets have been on. After 5 consecutive weeks, markets had trended lower since the start of this war in Iran. We finally saw some green this week, albeit on a 4-day trading week, but a win is a win, and we will take it. We did get some jobs data this week, which we'll cover here in a moment, as well as some other interesting things that caught our eye underneath the hood of the market. So let's get right to it. As we said, markets notching a win this week. Interestingly enough, with the markets closed yesterday on Friday, we still got a jobs report with the market closed, right? So we'll have to wait till Monday to see what type of reaction the market gives us. But we saw that the U.S. payrolls rose by 178,000 in March, more than expected, with the unemployment rate sitting at 4.3%. Now, 178,000, any job growth is good, and 178,000 is not by any means an outlier type number, but if you recall back to last month, we had a negative number. We saw minus 89,000 jobs lost in the economy in February's report reported in March. So this was an important number to see continued positive growth, right? Because it kind of suggests that either, A, last month was just an outlier, or B, maybe there was some bad data in there. Because it's really the only month over the last couple of years we've seen negative job growth. So nonetheless, good to see the number come in positive. It came in well above expectations. I believe the estimate was for 59,000 jobs added. So we got almost 3 times that. Unemployment rate sits at 4.3%. So we'll see on Monday what the market does with this number, if it reacts to it at all. We continue to be in a place where everything is news driven at this time, right? It's all about what's going on in Iran. What are the headlines coming out of that situation? That is really has been and will continue to dictate where the market goes and how the market reacts. So let's take a look at the market here together and see what we learned from this week. So, like we said, finally a winning week after 5 consecutive weeks lower. We did get a good reaction. If you think back to last week's videos, for those of you that tuned in, we outlined some additional support levels, right, as the market had continued to press to the downside. So we did get a good bounce off of an important support level, which was a level that had marked some importance in the past, right? If you look here and now here, the market, excuse my poorly drawn arrows here, but the market is recognizing this level as a familiar place at familiar price levels. So that's good to see a bounce from these particular levels. Of course, any bounce is only as good as how long it holds, right? And so if we come out next week and roll over and head lower, last week's bounce was for naught. So we will see what the price action tells us as we move into next week. Now, there's a couple other things that we're noticing in the market here that are important. And I think that it bears suggesting that really there's 2 different ways that this could go, okay? The market now has become fixated on peace talks, right? That is the new thing that we constantly hear about. Whether they are in peace talks with Iran, or they not in peace talks with Iran, there's a ceasefire, but then there's not a ceasefire, right? There's a lot of conflicting news that's affecting the market, and that's fine. The market will always deal with various sources of information and misinformation, and it will sift its way through these things. But this continues to be something that the market is fixated on. So any hints of peace talks, right, which we've had a couple over the last 7 to 10 days, we see an immediate positive reaction in the market, only to have, some minutes or some hours later, somebody from Iran comes out and says, no, there is no peace talks, and then the market settles back lower. So I think the market now is kind of getting a little bit ahead of itself expecting that this is all going to be done, dusted, and wrapped up, in within a week's time, right? And so sometimes when markets get a little overly optimistic on things, which could be the case here, it tends to complicate things a little bit. It tends to complicate things for the market. So I am not prepared just yet until we have the balance of more information to come and change the path that we expect the market to take. Now, I will say the price objectives you see above here, and again, this was kind of targeting mid-year, and we think higher by year end, those price objectives still hold. We still think the S&P will trade 8,000 this year on its way to 8,500. We still think the NASDAQ will trade its way to 28, 30,000. The question that is in our mind right now is it a possibility that the timing of this changes, right? When you're in a bull market like we are in, a secular bull market, these trends are very powerful. And they tend to have little in the way of being able to stop them. However, Trump has a knack for interrupting these trends. Okay, he did it last year in the first quarter with Liberation Day and all the tariff terror, and we're doing it again now with the Iran war or operation or whatever you want to call it. And so when you interrupt a bull market trend like we have here, right, the market should be further along, higher at this point in time, and clearly we have this situation that has come out of left field to throw the markets a little bit of a curveball. Sometimes the market needs an opportunity to kind of repair some of the damage that has been done. Now, again, if we get a peace deal and the Strait of Hormuz opens up and oil comes flying back down, then all bets are off. Markets can continue on higher, unabated, and we can catch back up to where we should be at this point. If that is not the case, if the Strait continues to remain closed, if these peace talks are complicated and they don't take days, but they take weeks or months, then there is a growing possibility that our trip to 8,000 and beyond, while I will maintain will still happen this year, it could potentially be a little bit delayed, right? So instead of becoming, early to mid-summer activity, this could potentially be something that we're looking at pushed back towards the end of Q3, beginning of Q4. So nonetheless, the gains will still be there. Our bullish conviction still remains. If anything, if the market decides to chop around here in this range and has a little bit more of a difficult Q2, then it'll give us more opportunities to buy stocks that continue to show discounts and buy the dip, if you will, right? Which we've been doing. It's been working. We will continue to do that. And like we said before, we will continue to hold on to our core positions who continue to see their earnings, revenue, and projections rise and rise and rise. So those are the stocks that you want to own. But again, not ready to change just yet. I think we need to see a little bit more take place here. Trump had put a 10-day, time frame, if you will, deadline on these peace talks. There's 2 days remaining in that 10-day window. So we'd be a little bit premature at this point to make any snap judgments before we see just how that, the next 2 days works out. Do they get something kind of in place or schedule some talks? Also, you have to remember that Trump and Xi from China have a summit scheduled for, I believe it's early May, late April, early May. That's going to be very important as well. And a lot of this stuff in Iran needs to kind of be tidied up before that summit because China is a partner with Iran in a lot of global commerce and oil and currencies and all that. So how this takes shape in the weeks leading up to that summit is going to be very important to see what type of leverage does the U.S. have going into that summit, or maybe lack of leverage if the Iran situation, is still a mess at that point. And so, again, either way, our targets for the year hold. I think we'll trade 8,000. I think we'll finish the year higher than 8,000. Okay, so whether it happens in June or July or October or November, I think we'll all be happy with the gains when they do come. And again, folks, this continued, ringing out of the market here, this suppression of the market from an exogenous threat like a war, all we're doing here is, pushing a beach ball under the water further and further and further. Eventually, when it is freed up, it's going to fly back higher. And that does not change at all in terms of how we view that. The timing part is tough, right? And the timing part is always difficult. I mean, that's just markets for you. Sometimes you can get the price objectives dead on right. The timing part can be a little murky. When we originally suggested the path that we would go on, where we would just fly higher into the mid-year, there was no war going on. So it is our prudent financial responsibility to assess the data and the information as it comes at us and be flexible in our views. So again, just to reiterate, if you want the takeaway line, we still believe those targets will trade 8,000, 8,500, NASDAQ 28,000 to 30,000. We will still trade those. The timing piece is something that remains to be seen. If and when I think it's necessary that we update our path, right, where we say, okay, maybe we're not going to tag this level by June, maybe it's September, we will come on here and we will update those together. But overall, good reaction by the markets this week at some critical support levels. And in just 2 short weeks' time, we'll be back in earnings season. Markets will have something else to focus on, right? So the question we should be asking is not when the war will end. More so, we should be asking, when will the market move on from focusing, in a hypersensitive way on this particular war? So let's look at some other things here. I thought this was very interesting. Earnings estimates continue to move higher amid the war, right? We talked about earnings estimates a couple weeks ago, and I had somebody reach out and ask a question and say, were those numbers from pre-war, right? And have they changed now? So here is that data as a follow-up to that question. You could see before the war started on February 28th, the day before, February 27th, earnings estimates for the S&P 500 were expected to grow by 14.7% for the year. And now, as of April 2nd, the war is a month going on in earnest here. Earnings estimates are expected to grow by 17.4%. Okay, so again, this is coming straight from the CEOs and CFOs of the largest publicly traded companies in the world. If the world is going to end, nobody has told these people about it because they continue to raise their earnings estimates. So that's good. This is the environment that you want to buy stocks in. If stocks are going to go down or sideways, but earnings are going to continue to go up, we want to be a buyer and a holder, an owner of stocks in that environment. Also, the credit markets. I will not bore you to tears explaining to you the credit markets, but essentially the bond markets have many subsets to them. One of them is the credit markets, right? You think about credit, not credit cards, but all different types of bonds and lending in corporate markets, okay? And the credit markets are where stress would show up in the financial plumbing of our financial system, if you will. This is where it would show up, right? And so you can see when this chart is moving higher in a fast, swift way, because this is just if you look wondering what this chart is, this is a credit spread chart. When this chart is moving higher in a swift way, credit spreads are widening, and it's a sign of heightened financial stress in our financial system. So naturally, when COVID happened, credit spreads blew out to the upside, right? A lot of stress in the financial system. Bear market in 2022, where the Fed started raising interest rates willy-nilly, right? You saw credit spreads widen higher, okay? Last year, tariff terror, Liberation Day, credit spreads widened, blew out higher in a big way. And so far, no stress is showing up in our financial system, right? Credit spreads are essentially at a 6-year low at this point. They've moved up slightly since the start of the war. Of course, you're going to get some reaction out of these things. And this is mainly due to oil moving up and interest rates moving up. But nothing to see here, folks. There's nothing here that suggests that there is stress or doom or gloom in our financial system. So this is a good thing. And we've been in this about a month at this, 42 days, I think, since this all kicked off. So we will continue to update you on this. I know that most people are saying, well, what is a credit spread? That's what I just wanted to share. On a very top surface, top level view of this, this is where we look for financial stress in the system. It is simply not there at this time. Let's take a look at our institutional friends. How are they feeling about the stock market? Well, they are still very bearish, right? A lot of things going on in the world. Who could blame them for being bearish? This is now 10 weeks in a row that bears have outweighed bulls in these surveys, okay? And they continue to be more and more and more emboldened, right? Okay, so one could look at this and say, well, Mike, you know what? For the last 5, 6 weeks, they've been right. They've been right. Yes, they have been right. Markets have been down more than they've been up the last 5 or 6 weeks. But you know what? These folks were bearish coming into the start of the war, and markets were getting ready to go, and then a war started, right? So they had a war help them out, okay? Every once in a while, geopolitical events come out of left field, and they support the bear case for short periods of time. But ultimately, it kind of tells you what the positioning is of all these people. So think about what might happen if we got a ceasefire that was in a prolonged way, or we actually had some substantive peace talks to end this war. There's a lot of folks that are positioned for the end of the world that are going to have to reposition back to the other side. So we thought that was interesting, and I think that over the next couple months, we're going to see a lot of changes in this survey and how people are positioned. Let's take a look at our individual investors, right? Individual investors here. Extreme fear, okay? A week ago, we went out at 14. We saw a slight improvement this week as markets came up a little bit. Now we're at 19. Still a lot of fear running through the markets. And again, not to beat a dead horse here, but of course, people are scared. There's a lot of things going on. But I can tell you, a lot of the stocks that we own and a lot of the components of the financial markets, not to say they don't care about a war, but they're getting to a place where they're going to get over it pretty soon. And when we get into earnings in 2 weeks, and there's actually something fundamental for these, for these companies to report and for the market to focus on, I think that's going to be an important catalyst here for the market. So let's take a look at next week's major economic reports and Fed speakers. We have the ISM Services Index on Monday, so we'll see how the service industry is doing. Previous reading was 56.1. We're looking for a 55.4% number. Now, just to give you a little context on this number, anything 50 and higher suggests expansion in the services index. Anything 49.9 and lower suggests contraction in the services index. So again, even with a war going on, services industry, still expected to expand. We're going to have some more Fed speakers next week. PCE, Personal Consumption Expenditure Index, on Thursday, right? The Fed's preferred gauge of inflation. We'll see what that number looks like. One thing that was widely missed last week, Fed Chair Powell did speak on Monday at a business summit at Harvard, and his comments were not widely reported, but one thing he said was, the effects of tariffs, the inflationary effects of tariffs, which they have been largely concerned about for the better part of a year, simply just have not shown up the way that they thought that they would. So it was an interesting dovish comment from Powell, right, who has really been anti-tariffs and kind of given a little bit of room here for the Fed maybe to come a little bit back off of their hawkish stance here, as Powell simply is entering his final 2 months here as Fed chair. Also, in terms of the Fed chair, the nomination of Kevin Warsh, the new projected Fed chair, has moved forward. So we'll see if he can get confirmed through the Senate and be, ready to go in time for the end of Powell's term. Next Friday, April 10th, we will have the CPI, the Consumer Price Index. So that, we have the PCE on Thursday, CPI on Friday, and we'll see, again, another month's look at the inflationary picture and what that looks like. So all in all, markets at least defended for now a critical level of support. We'll see if they can do anything with that next week. Can they continue some momentum? Oh, also of note, Thursday, because the market ended the week on Thursday this week with no market trading on Friday, we had been down 9 consecutive Thursdays, right? We talked about that late week weakness that keeps showing up in the markets because nobody wants to carry risk over the weekend. And so we finally saw a positive close on a Thursday for the first time in 10 weeks. So not really much to take from that. I just thought it was an interesting fact that, if you feel like we've been down at the end of every week for a long time, we have. It's been 9 Thursdays in a row. And I'm sure Fridays is not far behind. But all in all, markets defending pretty well, a very critical support level. We will continue to watch and observe what the market does and what the data dictates at this point, and we will make adjustments as necessary. So with that said, I got one programming note. Next week, I will be traveling towards the end of the week. So we will get an update out for sure because there's a lot of important things going on. Hopefully it'll be our usual video update. We might have to pivot to a podcast update, which many of you who have been along the ride with us for a long time know on occasion we have to do one of these updates via podcast as we are traveling and if we don't have all of our video equipment available and at the ready. But whatever it ends up being, we will certainly get the update out to you to make sure that we can convey to you the important information as we see fit. So we hope you have a great day, a great weekend. Happy Passover, happy Easter. Hope you'll have great holidays out there, whatever it is that you celebrate. And if you have questions about anything that matters with your money, of course, reach out to us. We're always here for you. Have a great day, and we'll see you next week.